Hello, I'm Alex Davies, founder of Wealth Club. Today we're taking a behind-the-scenes look at seed investing in the UK and the impact the Seed Enterprise Investment Scheme, or SEIS, has on entrepreneurship and the wider UK economy, and what's in it for private investors. The Seed Enterprise Investment Scheme, SEIS for short, was introduced in 2012 to encourage experienced investors to invest in very early stage companies. Since then, around £1.9 billion has been invested in over 19,000 companies. SEIS companies are often technology focused, and the SEIS investment may be among the first equity funding they receive. SEIS qualifying companies must be less than 3 years from the start of trading and can have no more than £350,000 in gross assets. Because of the high risks of backing such young companies, the scheme provides tax incentives, including income tax relief and capital gains tax relief of up to 50% of the sum invested. To learn more, we're here today with two leading SEIS fund managers, Ed Pryor of SFC Capital, manager of Startup Funding Club, SEIS, and Fred Sonia of Hatch, a respected EIS and SEIS fund manager. We're also here with startup founder Elliot Herod-Taylor, CEO of The Bunch, a successful British company that has received investment from both SFC and Hatch. Hello. Ed, first off, tell me, why is SEIS such a good scheme?
So SEIS is really great for two reasons, really. One, as a tax relief tool, and two, it's a great way to gain exposure to the next generation of British innovation and startups and all of the upside potential that can come with that.
And I think, just to add, it's probably the best tax relief in the world. I mean, there's countries all across the world that are very jealous of SEIS. I think it's an amazing tax relief for the UK with some really incredible tax benefits.
I think France and Germany actually are countries looking at it right now. So actually, for UK PLC and the government, it's also a brilliant selling tool for the vitality of British innovation and early stage venture. I think it's really been a big contributor of the last decade of success, where we've now, I believe, got the same size venture capital ecosystem as the rest of Europe combined. So it's a really positive story for Britain. And
just going back to the sort of rules, how much tax relief do you get? How does that work? And also, how much can you invest in each year?
Sure. So it's 50% income tax relief. It's 50% capital gains tax reinvestment relief. It's 100% inheritance tax relief when you hold the shares for a period of 2 years or more. And this is something that makes it a really good tax planning tool. You pay no capital gains tax when you come to sell those shares for a profit. And should an investment fail, and the truth is in early stage investing that many investments do fail, you also claim loss relief at your marginal rate. So it's a really, really effective tax relief tool for that reason. And actually, in the last kind of 15 months, we've had a bit of a transformation in the SEIS market, where the rules were updated, which have made the scheme much more appealing to investors and much more useful to startups. So startups can now raise with SEIS within 3 years of trading. Previously, it was 2 years. Now, this matters for the investor because that changes the risk profile quite dramatically. A 3-year-old startup is very different to a 2-year-old startup. It also matters for the startup because the startup can continue raising with SEIS, which makes the job a little bit easier. It's still a difficult task, but it makes it a little bit easier during those initial growth periods. The amount that investors can invest has also been increased, going from £100,000 a year to £200,000 a year. And interestingly, this has brought in a whole new demographic of investors, so ultra-high net worths who beforehand didn't really use the scheme. And that's having an interesting rebalance of the demographic of the market, because at a time of economic challenges where we're seeing some smaller investors leave the market, they're being made up for, and actually more than made up for, by a number of larger investors who are really actually going into SEIS funds rather than direct investments to take a portfolio approach. And that's, again, changing the market, where I think you're seeing a kind of shift in balance between direct investors and fund investors. And I think ultimately that will be a positive for the efficiency of the market.
And have the new rules helped you, Fred?
Yeah, I mean, the difference between 100k a year or 200k a year for investors, I think, is significant. I think as a fund manager, the biggest difference actually is the amount that we can invest, going up from 150 to 250. Ultimately, it doesn't matter how much you invest in a company. There's only so many companies you can invest in a year, and the same amount of work is required for a £250,000 investment or a £150,000 investment. That's also true of a £5, £6, £7 million investment. Ultimately, it's 9 times out of 10 the same amount of time and work. So it's enabled us as a fund to raise more. It's enabled us to support companies further. And I think getting more money into a company at its earliest of stages is really important. The other point I wanted to add to the tax reliefs is, I think if you add all the tax relief up, for a higher rate taxpayer, the actual capital at risk is something like 13.5p. So it's actually very minuscule compared to the total number out there. And then the gross assets point is really interesting on the company side. Gross assets can change over time. So we've invested in companies under SEIS that have had £1 million of non-SEIS and non-EIS, non-VCT investment in them before, but they still meet the gross assets criteria because the cash has been spent, the cash has been burnt, and they're still under 350. So actually, I think there's this perception that SEIS is only ever for the earliest of stages, but we have made investments in slightly later stage companies still under SEIS.
I think you're right. A lot of people don't know that.
Yeah.
And what sort of return should investors be expecting from a fund?
I laugh because I think it's a great question for the whole market. I think that investing in early stage companies means you should strive for really strong returns. And in my eyes, really strong returns are double digit type returns. I think the jury's out for many funds about whether that's achievable or not. But I think striving for those types of returns means that, if you miss, you should still end up with significant returns. I think in the UK, we're not really in the business of building many £billion companies a year. And I think the sweet spot is more in the 100 million range. But the beauty around SEIS, I could speak for Hatch, we invest in companies typically at sub £5 million valuation. So even after dilution, even after a few more rounds of fundraising, an exit of 50 to 100 million is really meaningful for those early investors. Take into account the 50% income tax relief at the beginning and that it's capital gains tax exempt or free is really, really attractive.
And Ed, SFC's been around for quite a long time. What's your experience with exits?
So we've had 30 exits to date, including 10 secondaries. So our average rate of return on exits is, I think it's about 14 times returns. Now that doesn't mean that all of our portfolios are 14 times. With early stage investing, only a few of each portfolio are going to drive most of the value. We target 3 times returns over the lifetime of a fund, which is a figure that we feel comfortable with and something that we can attain.
And is that actually panning out?
Yes, it is. Yeah, and there are some portfolios that are really on track to go way beyond that. But again, it's a figure that we thought was comfortable and we could defend as something that we're confident we can reach in each portfolio.
And over what time period is this happening?
So with SEIS, because it's you invest within 3 years of trading, really you're looking at a 7 to 10 year time horizon for a full maturity of a fund. That's not to say that all of your money is going to be tied up for that long, because there are exit opportunities along the way. Our track record says that about from year 4 onwards, we're starting to deliver exits. But the secondary market actually waking up over the last couple of years makes for a really interesting market development. So one example is a company of ours called Lunio, where we sold 10% of our holding in Lunio, but that's actually already delivered the value of the portfolio, so it's de-risked it. And with more and more secondary opportunities happening, there's more liquidity coming in the market, more reinvestment back into the market. So that's been a really positive development too.
That's great. Elliot, tell us about The Bunch. What does it do? How long have you been around?
So The Bunch is a platform that manages household finances for people, aiming to make it more convenient and also to manage a wide range of different administrative tasks that you have. So I set up Bunch when I was 19 at Leeds University, 8 years ago now.
You've raised money from both SFC and Hatch.
Yeah, thank you.
How was the experience? How was the experience of raising money for someone who's in university, straight out of university, no experience, I guess?
Yeah, so I think it's quite a daunting thing, regardless of if you've done it loads of times before or not. But I think what was really supportive was having investors that understand that as well. So they deal with entrepreneurs that are in sort of SAIS, first-time investments all the time. And so being actually led through that process by both of them was a really sort of useful exercise, especially as someone that never raised money before.
And how did you go about finding investors?
That's a tricky question. I think if you're going to go for more of a fund approach, like an SFC or a Hatch, you can quite easily sort of find them through their reputations on LinkedIn and also online. But going and finding high net worths is a much harder thing to do. They don't walk around with a sign on their head, or you can't Google them. So I think as a young founder, particularly going and working with SEIS and EIS funds to start with was a really good approach, because they can also help introduce them to their network as well.
I think something that's easy to forget on the fund manager side as well is that these businesses are real businesses. So we have this horrible term called deals, and I hate it, but internally it makes a lot of sense. We refer, Elliot, to a company as a deal. What we actually mean by that is an investment profile for a business at that moment in time. But the reality is that you are a young founder. Founders are young. They tend to be first time raising money. And actually, I think it works both ways.
Yeah.
We need to support you through that process as well and show what's fair and what's not. And over the last couple of years, we've seen some great transparency. There's a platform called Landscape in the market now, which is a bit like TripAdvisor or Trustpilot, but for funds. So founders that have pitched and have raised money from funds can rate us. And I think it's great because it's actually showing true transparency.
I think it also shows the role that SEIS funds have carved out for themselves in the market, where we tend to go a little bit earlier than when a VC fund might be there. And you could kind of consider us as a big check angel investor, which makes it can streamline the task of a new founder. But actually, it's just a really important place to really fuel that early stage innovation ecosystem for the UK.
And what did you see in Elliot's company?
Elliot knew the problem firsthand, which is always appealing when you're looking at a new founder. So if they've experienced the pain that they're solving, that's usually a very good first step. Now, because of the market, their beachhead market being universities, and Elliot being at university at the time, that meant that he also wasn't very experienced. And what stuck out to us was that Elliot was happy to surround himself with experience and take suggestion, take advice. But still have kind of that North Star vision that you really need as a founder. So the age didn't matter. It was it all kind of came together nicely.
I think for me, I would describe that as kind of attitude, good attitude. I think you can support a founder with most things, their future fundraising, their go-to-market motion, their sales strategy, whatever it may be. And even the domain experience point, I 100% agree, by the way. I think having that domain experience of the problem for yourself is amazing. But people that don't have domain experience also go on and build great businesses in a space. The one thing that sets everybody apart, though, is the attitude to actually get it done, actually to live and breathe, and actually not to give up when things are tough. And I think that's what really stood out in our conversations with Elliot, both pre-investment and post.
It's why the founding team is so important for us when we make decisions at the early stage. So over the lifetime of a business, the business model might change, they might pivot into a different market, but people rarely change. And so you can get a good sense of whether the business has a chance of being successful, even at those early stages. And that's what we saw in Elliot and others like him as well.
And Elliot, how important do you think the tax reliefs were in getting you money in the first place?
I think it's one of the most important things in an early stage business. If you speak to any investors, you can get them as interested as you like, but they always ask you what tax efficient availability have you got, whether that's SEIS if you're at that stage or EIS. So I think it's imperative to the ecosystem of startups. I spend a lot of time with lots of different founders. I don't know any of them that haven't raised sort of tax efficient money. I think it's the natural stepping stone. And I think the SEIS provides founders that are still looking for that product market fit, that space to actually be able to take their time and innovate properly. And then obviously EIS is that where you go to extend that and grow that. But I think ultimately, without that, you wouldn't have half the startups, and I don't think a lot of them would have made it.
And were you just looking for the money when you started, or were you looking for help?
I think I was looking for a mixture of both. As I said, I was a young founder. I'd wanted to sort of surround myself by grey hair. This was an opportunity to work with people that had also built businesses. It was one of the things that attracted me to Hatch. It's full of ex-founders who have been on the journey, so they were understanding. And also, I think the other element was having the right advisors around the business are really important, because a lot of the issues that happen are not completely new. They happen to every startup, and it's just different phases of the journey, and having the experience to navigate them, I think, is really important.
I think the reality is that founders can choose who they raise money from. I think there's this perception that only investors or fund managers hold the cards, but the best founders will have multiple term sheets, multiple offers, and that means that actually as managers, as fund managers and investors, we have to do a really good job of convincing Elliott and others why they should take our money over somebody else's.
And what characteristics, and you've told me about what you liked about Elliott, what generally are you looking for? What are the key things you'd say?
So in a founder, we're looking at the founding team. We are looking at how we think they will work together and with us and others when things go wrong. I think most times you focus on when things are going to go right, but the reality is along even the best startup to exit journeys in the world, lots of things go wrong. And then we're really looking at what we call at Hatch a pain in the present. What we mean by that is we're focused on a real world problem today, not some kind of future mythical opportunity. So we're looking at, are you building something for a pain today that is either going to have a massive impact in an organization or for a person within that organization, and are they going to be willing to pay for it today? And then the last thing, I guess, which is kind of new for the market, bizarrely, over the last few years, is revenue. Businesses go out of business because they run out of money. So we are very focused on that path to profitability. Even if you choose not to go down that road, you choose to raise or burn more capital, the ability to be able to flick back to profitability or flick back to revenue is really important.
We've developed a scoring system which we take every startup through, which has 60 data points on it, as a kind of first step in our evaluation process. I mean, there are many key points related to level of innovation. Is there capacity to scale into a large enough market? Is there an acute market need that they're solving? Really, at the crux of it, though, is do they have the potential to deliver outsized returns for your investors? I said before how not all of your investments are going to be successful, and so those that are really need to deliver outsized returns, so 10x and above returns to carry the rest of the portfolio and reach those targets that we discussed about, whether it's 3x or more. And that's what's known as the power law, which is what guides venture capital. And that means basically you have to make enough the value that you're going to extract from your investment is going to be driven by only a minority of the investments that are made.
So what sort of failure rate do you get, do you anticipate?
So at the moment, our portfolio failure rate is about 15%, but that's actually not a fair representation. That's going to grow. That's only 15% at the moment because most of our investments have been made in the last 3 or 4 years. Pareto's 80-20 principle is relatively useful to go by. It's probably a little bit more extreme than that. But really, in a portfolio of 20, you're going to drive most of your value from 3 of those startups, some of your value from 3 or 4 more others. And then the great thing with SCIS is that you get loss relief at your marginal tax rate on the remaining 50% not originally claimed for with income tax relief. So you want these failures to happen in the portfolio because you'll be getting value through the loss relief anyway.
Fred, it's been a funny 2.5 years. It's in a way lots of people have gone right off venture investing. How has it been though as a manager raising money for SCIS?
So the most amazing thing to come out of the crazy budget a couple of years ago was the increase in SCIS limits. And it's the one thing that was announced at that budget that wasn't changed, wasn't reversed on. So I think we're incredibly fortunate that SCIS has gone up from that original 100k a year for investors to 200, or that original 150 for companies to 250. So actually, we've seen a lot of growth in SCIS. Now, we are a new entrant, I guess, in SCIS. We launched our first SCIS fund 3 years ago, coming from an EIS background and some institutional money we manage. So I would expect at this stage us still to be growing, obviously. But there's a lot of capital out there. I think the biggest shift I've seen in market is money actually coming earlier, funds coming into SCIS, people wanting to invest earlier. The reality is if you're a later stage fund and you invested in a business, pre-pandemic at some crazy valuation, there's very little headroom. There's, where does that business go? The IPO market's not alive at the moment. So actually, we're seeing more and more capital come earlier. So for me, it's more about winning companies, and investing, really smartly. But yeah, we've seen a buoyant market in early stage.
And are there better opportunities?
I think the pandemic, my view is the pandemic did two things for founders. One, it enabled people to work from where they wanted to. And 75% of our capital is invested outside of London. I think that's relatively unique. I think most venture capital is centered around London. And we've definitely seen that increase since the pandemic. Because if you want to be in Bristol, or if you want to be in the countryside, you can, and there's no reason not to. So that's been great. The second point on better opportunities is around the types of founders that we're seeing. I think people have kind of decided that now's the time to go for it. If we're not going to go for it, then when are we going to? So in many ways, I think there's some positives that have come to SEIS since the pandemic and since the budget.
And Ed, do you concur?
Yeah, I do. So in terms of quality of startups, that hasn't been in doubt over the last couple of years. The level of innovation coming out of the UK is better now than it has been before, and we're tapping into really exciting markets of the future in areas like medtech and AI and other places, which make us a very exciting place to invest. I think actually the amount of investment levels at the early stages, it did drop off from a post-COVID high where we had a lot of tourist investors enter the market and then leave again. But actually, if you cast your eyes back further on the data, we've actually just kind of re-corrected to the same trending pattern we were in before COVID. So I think that's, we've still got a vibrant early stage environment. And actually, I think if there has been a drop off, then probably what we've seen is a bit of a consolidation around trusted brands and those that are kind of larger and more well known and experienced in the market. So it's so in terms of the level of innovation, that's very good still.
And are there particular sectors at this moment that you feel are particularly worth chasing?
Yeah, so we're diverse. We're diverse investors. So we invest across a spectrum of innovation economy sectors. There's obviously a lot of talk about AI at the moment and the applications for use that can have. As I said before, we seem to be moving into more of a science-led economy. So that opens the door to opportunities in deep tech and life sciences, biotech, those sorts of areas. But we like to kind of cast ourselves across all of those high growth, high potential sectors. To spread risk across sectors because there's a lot of perpetual change in different markets, but also to capture different growth market opportunities.
We are B2B only investors, so we don't invest in direct to consumer. We've made that decision because we think B2B investing is very metric driven. So we know what metrics a company needs to raise their next round, and we also like the multiples in B2B. We're also quite wary of buzzwords. So I think 3 years ago, every pitch we had the word crypto in it, or blockchain. Last year was Web3, and now it's AI. So that's when we really bring it back to our kind of philosophy around this pain in the present concept, and what are you actually trying to do? And I'm all for AI. I think AI is going to be a great enabler of lots of things, but I think the word is used very loosely at the moment. But yeah, from our side, business to business, and software companies with reoccurring revenue. We love reoccurring revenue.
I think you touched on a key point with that earlier when talking about the need for revenue or the kind of increase in popularity or fashion with revenue. Really, I think what investors are looking at today is wanting real businesses that are solving real problems. I think that a few years ago, people might have got caught up in kind of heady ideas of what a business should be doing, but actually we've learned over the last couple of years that a business is there to make money. And a good way to show your worth to investors is by making money.
It's funny though, because a lot of young entrepreneurs are solely like hearing what's going on in America and these amazing multiples and all these amazing sort of like fantasy stories. And I think a lot of them are probably confused that actually that's what a lot of UK investors want. So I'm sure you see a lot of pitches with unbelievable like growth and getting to sort of unrealistic stats, but it's quite interesting because obviously Europe's a very different sort of risk profile, but from a startup perspective I think it's quite hard to sometimes know where to pitch yourself. You want to be ambitious, but you also then don't want to be sort of unrealistic. And I think as a startup founder, it's been quite encouraging to have like support from both of you guys in terms of how do we pitch ourselves in a sort of way that's ambitious but also realistic.
And Elliot, if there was anything the government could do to help people like you found and scale businesses, what would that be?
I think it's got to be improving the access to capital. I also would like to see more sort of match funding from things like BBI. I think that's been an amazing asset to ourselves. And then opening the doors to more investment from either themselves or from attracting high net worths to keep their money in the UK and invest into startup businesses.
And Fred, any further changes you'd like for SCIS?
I think the headline one is to increase the 250 into companies. So something like 500,000 would be amazing. Like I said earlier, it would take us the same amount of work. We would invest in the same number of companies, but we would invest twice as much capital. And I think that would be great for the UK ecosystem. I think there's this other kind of nuanced one around SEIS has to be invested prior to EIS or VCT. And I understand the reasons why, but I think some flexibility occasionally on that point, maybe within some parameters, could be really interesting as well.
And Ed?
Well, I think a kind of big one is the lack of awareness that there still is around SEIS among the would-be pool of investors. So less than 10,000 people invested in SEIS last year, and that's out of a market of over 2 million people in the UK earning over £100,000 and who could therefore qualify as high net worth investors. And what that tells us is that we're only touching a small fraction of the potential. And actually, if we want to turn the UK into a startup powerhouse and a world leader in key sectors of the future, we really need to be looking at how we grow that base, and SEIS is a really good opportunity to do so just by getting the message out there and helping more people understand how it could be used as a tax relief scheme as well as as an investment tool.
I think that's a really interesting point because I only found out about these tax efficient investments through advisors. But we initially went to institutional banks to try and raise loan capital and funding, but their risk profiles is way less. But we were never sort of suggested, what about this option? So awareness, I think, is actually something that is lacking definitely on the startup side as well as the investment side.
Okay, and finally, Fred and Ed, why should investors invest in SEIS this tax year? Very briefly.
Well, with a lot of uncertainty around various tax rates and a lot of great stuff happening in UK startup world, it makes for a very fertile opportunity for investors, to protect wealth, and also to invest in the potential upside of Britain's best innovation. So there are many different reasons, and now would be a very good time.
I think on the tax side, it's the greatest tax relief in the world for investments. It is the scheme. It is number one in terms of tax relief. And I think more importantly, looking past the tax relief on the investment side, you build a portfolio of maybe 10, 15, 20, depending on the type of fund you invest in, really early stage businesses at the cutting edge of technology at a really exciting time in the UK.
Well, Fred, Ed, and Elliot, it's been a really interesting chat. Thank you very much.
Thank you.
If you're watching on YouTube, please press like and subscribe to the channel for more.